fell more than 9% in after-hours trade. Shares of other U.S. retailers also slumping. Target sliding close to 5%. Costco off by about 3%. Let's bring in Yussef Gheriani. He is Director for Investment Operations at IHT Wealth Management. So, Yussef, just looking at these retail earnings and Walmart in particular, you think we'll be okay. But in anticipation of the GDP print coming up later this week, how strong would you say the U.S. consumer still is?
Look, the Walmart earnings are obviously that's disappointing. Nobody likes to see revisions downward, and they've already guided downward once this year. That said, the U.S. consumer, we think, is still in a pretty good place. Walmart doesn't necessarily reflect everything that's going on in the S&P 500. Walmart is pressured by not only inflation on the goods that they purchase and that they resell, and by the ability of the consumer to purchase, but also by labor costs and the cost of fuel to move things from point A to point B. So they've got kind of all the different inflation pressures that are hitting them, whereas the general consumer, they're out there spending, they're still out there shopping. Maybe they have to pull back here and there, but broadly speaking, we're still pretty optimistic about the health of the U.S. consumer, especially at the top end.
So you would hesitate to extrapolate the latest earnings from Walmart to, get a sense of the wider consumer discretionary picture. But even if we don't see a recession, we might still get that downturn in the U.S.
Yeah, I think a lot of people are expecting a recession, and we will probably get one at some point. That doesn't mean, though, that we need to put the brakes on and sound the alarm. There's a huge difference between a recession like 2008 and a recession where you have unemployment at 4, maybe rises to 4.5%. There's a massive difference between a consumer that is pressured by inflation and maybe can't buy everything that they want, and a consumer that doesn't have a job and is unable to buy anything. That's a huge, huge separation. And we have to keep in mind when we talk about a recession that we already see the markets down 20, 25%, depending on which index you're looking at. So we've priced in a lot of pain. Looking forward, that's where you have to look as an investor. What do you want to buy? Where do you want to be? And I think that this is a market that you want to be invested in.
Okay. How dependent is all this going to be on how high the Federal Reserve eventually will need to raise rates? And is it too early to be talking about peak hawkishness?
It's not too early to be talking about peak hawkishness, but you do have to take everything that the Fed says with a grain of salt. The Fed obviously is in a very, very difficult position. They are responding to inflation expectations, which unfortunately for them are dictated a lot by the price of energy, by what the consumer sees at the pump, which is not necessarily something that they have a lot of control over with interest rates. They're using interest rates to try to control the economy as a whole and control inflation expectations, even though those inflation expectations might be driven by a couple of very key points that they don't have a lot of direct control over. So we expect to see a couple more hikes here, but we do think that probably peak inflation is past, it's going to start tapering, and therefore the Fed is also going to be able to start slowing down and curtailing some of their aggressive policy.
Okay, you touched on the top earners in the consumer space earlier. Obviously, we're seeing a divergent picture. It's a K-shaped recovery. How do you play this?
I actually would probably avoid the consumer as a whole. As much as I believe in the U.S. consumer, I think U.S. businesses are in a wonderful place. If you read investment surveys, and officers at the companies are being conservative, they're pulling back, but at the same time, their balance sheets are great, and they're continuing to forecast large tech spends going forward. So we think that you want to be invested in technology, you want to be invested in business-to-business technology, automation, cybersecurity. These are places where the companies are continuing to spend money, and as they continue to spend, profits are going to go up. And they also don't face a lot of the same inflation costs that some of the more consumer-facing names like the Walmarts of the world are going to be facing. So lots of upside in the United States technology sector.
Right, staying with tech as a secular theme. Yussef, we'll leave it there for today. Thanks very much for sharing your time and your insights with us. Yussef Gheriani is Director for Investments Operations at IHT Wealth Management. Well, steep rate hikes and then a U-turn into an interest rate cut by next year sounds unusual at a time when central banks around the world are lifting rates rapidly to wrestle inflation. But Wall Street investors are now pricing in the odds that the U.S. Federal Reserve is trying to mount a sharp but short policy squeeze. That's when it deploys a short series of aggressive rate hikes to cool the economy enough to tame inflation and then sharply pivot into a rate cut next year. That would give the economy some slack to prevent a hard landing. Forward bets on overnight index swaps show money markets are expecting the Fed's benchmark rate to peak at around 3.3% in December and then start falling by March.